Hello and welcome to TradingFloor.com's weekly Asia Focus. Monthly data from China has just been released and indicates high inflation, which will put pressure on interest rates. And the G20 summit in South Korea, the focus is on global currency imbalances as central bank authorities have been trying to keep down the value of their currencies to stimulate their economic growth. So can we avoid a currency war, or at least can we prevent an all-out trade war? And with us from Singapore, our weekly correspondent Andrew Robinson of Saxo Capital Markets. Welcome, Andrew.
Hello again.
And interesting times at the moment. We've got some of the data coming out from China in the lead up to the G20 summit. Can you give us a bit of an overview of the figures that have come out?
Yeah, certainly we had a whole string of data for October. Most of it was in line with forecasts, but I think the two takeaways that we can take from this release is basically the CPI data and the new yuan loans. Basically, inflation ticked up to 4.4% year on year, higher than the 4% expected by the market, and certainly a lot higher than the 3.6% last time round. And I think most of it was attributed to higher food prices. But we've had comments from Chinese officials since the data came out that they are actually a bit concerned about non-food items as well. So it certainly looks as if they are on an inflation watch, and I do think it does suggest that the Chinese authorities will be looking to hike interest rates in the very near future, quite possibly before the end of the year. If we look at the yuan loan situation, then they remained at elevated levels, and I think this is justifying what the Chinese authorities did yesterday, where they increased the reserve ratio requirements, thereby reducing the amount that banks can on-lend to their customers, etc. A 50 basis point hike, I think, was quite justified given the high level of loans at the moment, and so everything is looking as if the economy is ticking along very strongly, not yet overheating levels, I don't think, but certainly ticking along strongly, and that's something that China will take to the G20 meeting.
And they will be getting a lot of attention at the G20 meeting, as will with the US and the Federal Reserve taking a lot of the spotlight, having just rolled out their $600 billion package. What are we expecting to see? Are we going to come to any resolution with the arguments to and fro about currency control and manipulation and quantitative easing?
I think the answer to that is probably no. We've had a lot of discussion in the run-up to the G20 meeting. Certainly the spotlight shifted away from China to the US occasionally, as you mentioned, with their quantitative easing measures. But I think the US will try and push the focus back to China about its FX policy. It's interesting to note that this week the dollar-yuan fix has been easing off quite steadily. In fact, this morning's fix was the lowest we've seen in 20-odd years. And this is at a time when the dollar is actually having a bit of a rebound. So I think maybe the Chinese authorities are doing a bit of window dressing ahead of G20. But I don't think G20 meetings are always a bit hogtied in as to how far they can actually go. So I don't think we'll see any major developments from the October meeting, where they had an agreement to try and improve the global economies. They'll obviously still working towards that aim, but I don't think we'll see anything concrete or anything too aggressive coming out of this weekend's meeting.
Now, we've seen through the whole currency discussions back and forth, we've seen equities and commodities rallying. Would it not be in China's interest now to let their currency strengthen a bit?
Well, yes, certainly. If you're looking at the amount of importing that China is doing on the commodity front, they've reportedly been hoarding all the precious metals. They've been buying up the base metals as well. So if they let their currency appreciate, then it makes their imports a lot cheaper. That obviously will work towards their aim of trying to combat the uptick in inflation. So it does seem to argue that it would be beneficial to the Chinese if they were to allow their currency to appreciate a little bit faster and a little bit more.
Okay, Andrew, look, thanks for the update for the week. And don't forget, you can visit tradingfloor.com for by-the-minute articles and updates on global markets and currencies, and you can also follow us on Twitter at tradingfloor.com. Thank you, and we'll see you next time.